Thanks very much indeed, Simon. Let's move now to looking then at what the vulnerabilities are of the region as we do see deterioration of the situation in the Eurozone, an awful lot hanging on the Greek election next month. Gillian Edgeworth of UniCredit, if I could ask you to address that theme for us. What are the vulnerabilities? What are the channels of contagion? And how vulnerable is the region as a whole to a worsening of the situation in the Eurozone?
Sure, thanks Neil. When we think about this question at UniCredit, we tend to think of it via three broad channels, namely, first of all, economic activity, secondly, the banking channel, and thirdly, a broader picture on capital flows, largely focusing on portfolio flows. We were I would say not very surprised, but we were surprised throughout Q4 last year, the ability of Central and Eastern European economic activity to hold up in the face of these persistent negative headlines out of the euro area. But what we have seen in the first quarter of this year is that this is now taking its toll on economic activity in Central and Eastern Europe. We had the worst quarter for industrial production in CEE since Q109 in the first quarter of this year. It was nowhere near as bad as Q109, but it was the weakest quarter since then. The euro area flash PMIs that came out last week suggest that Q2 isn't going to be a whole lot better for Central and Eastern Europe at this stage. Now, when we look at Q1, there were weather effects at play, there were some one-offs, but on the whole, it does seem like what's going on in the euro area at this point is taking its toll on economic activity in Central and Eastern Europe. For some countries, this is a weakness, countries like Poland, countries like Russia, but there is domestic demand at play as well, which can offer some support. But for other countries like Czech Republic and Hungary, where domestic demand has really not gone very far at all since 2008, this is really removing the sole support of growth for the region at this point. Putting this in a broader context, I think what is impressive is the fact that policymakers across Central and Eastern Europe have much more quickly reacted to a significant downgrade of potential growth post-2008 in the region. And this means that fiscal balances and current account balances are now in a much better shape to facilitate some sort of slowdown in economic activity. But nonetheless, unfortunately for now, it is happening. The second channel, which is getting a lot of I guess, press at this point, is the link between Central and Eastern European banks and banks in developed Europe. The positive news is that I think since 2008, in any case, credit growth in Central and Eastern Europe has been deposit financed. It has not been reliant on aggregate on new credit from developed Europe. That said, what we're seeing right now within the euro area lowers the chances that we will get fresh inflows of medium to long-term capital into the banking sector. And I think another point which is often missed out is that even if the liquidity was available within the euro area to provide this funding, the cost of mother bank funding has increased to the extent that it makes it less feasible for banks within Central and Eastern Europe to develop or to borrow from developed Europe to finance the credit channel that way. The last, I guess, point I'd like to make is on portfolio capital. Portfolio, or the composition of capital flows to Central and Eastern Europe post-2008 has changed significantly. We have gone from a world where capital to Central and Eastern Europe is dominated by medium to long-term bank capital to a world where capital to Central and Eastern Europe is lower than what it was 2008, but still positive and dominated by portfolio capital. Now, any capital to the region is a positive, this much is clear. But firstly, this portfolio capital is differentiating very significantly. Turkey and Poland have absorbed the vast majority of the inflows. Many of the countries that saw IMF programs have only seen portfolio flows come at a much later point. And then you have countries like Hungary and Ukraine where engagement with the IMF has halted. And these countries are still struggling to access external Eurobond markets in the face of very large redemptions to the IMF over the next few quarters and throughout next year and into 2014. This portfolio capital is a positive on the whole, but it is much more volatile than what was in the past the bank capital coming to this region. We had an excellent first half 2011 in terms of portfolio capital. We had a much weaker, almost a sudden stop in the second half in terms of capital to Central and Eastern Europe, in terms of portfolio capital. And this is causing problems for governments, this is causing problems for central banks. We're seeing the Turkish Central Bank employ a number of policies to defend its currency. The Romanian lira trading at a record high. Serbia frequently in its market defending its currency. The Hungarian Central Bank hiking interest rates in part to compensate for lower risk appetite. The bottom line, I think, when you put this all together is that there's every reason to believe that many countries within Central and Eastern Europe can outperform what we're seeing in the euro area in a very significant manner. Russia, Hungary, Turkey, Romania, the Baltics. But also policymakers need to be nimble, we think, in the region. Bad policies are going to be quickly punished. Good policies take longer to be rewarded than in the past. So we need to be nimble, I think, in the region for some time to come.